please subscribe and don't forget to press the bell icon to get notified whenever we upload a new video.
Welcome back. You're still tuned into Power Breakfast on CNBC TV18. Well, on to some earnings expected today. Bank of Baroda will be reporting its Q4 numbers. Well, Abhishek, the last of a couple of bank numbers left now. So what can we expect?
Well, Ekta, good morning. The street is expecting a loss for the first time in 8 quarters, and that is owing to the fact that there is pressure on asset quality. So slippages, that is fresh accretion to NPA, is expected to remain elevated. Phillip Capital is expecting a slippage of 9,000 crore. Last quarter, it was at 5,500 odd crores. So over the last 4-5 quarters, the slippages has been in the range of 3,500 to 5,500 crore. So due to slippages increasing, asset quality is expected to increase or deteriorate. So gross NPA, which was at 11.3%, can see an uptick today. So overall provisions are expected to remain elevated due to higher slippages, aging of NPAs, and mark-to-market losses on the treasury portfolio, where the bond yields have increased over the last 3 to 6 months. So this is the fact, and loan growth is expected to remain stable. So loan growth for Bank of Baroda on the domestic book was close to 4% in the previous quarter on a quarter-on-quarter basis. So if domestic loan growth comes between 15 to 16%, that should drive the net interest margin being sustained at 2.6 to 2.7%. Overall, analysts on street are expecting NII growth of 24%, while net loss can be at 122 crores. So if you look at the stress portfolio, the overall stress portfolio of Bank of Baroda is close to 29,500. So if you remove 20% of overlapping book, if the slippages come in from this 24,000 crore, then it'll be positive. Otherwise, it'll be negative. Back to you.
All right, Abhishek, we'll keep an eye out on this PSU bank as well. But let's shift focus to the pharma space then. Sun Pharma and Cadila, they will be reporting their numbers. But Ekta, Sun Pharma first, and they launched a new drug too.
Well, yes, I'll come to the fact that they've launched Glumetza generic in the US markets in just a bit. But in terms of the numbers, what we can expect for Sun Pharma is more of the same. A sluggish sort of revenue this time round. The management said that they expect Q4 to be similar to Q3, where hence then the revenue would be just about flattish. And we have the margins which could come in at around 20 to 21%, with the profit also being impacted because of the US generic pricing pressure. So that would be key in terms of commentary for Sun Pharmaceuticals. What's happening with the US generic pricing pressure, what's happening with the Halol facility, as well as what their specialty pipeline looks like. Now remember that the reason why Sun Pharma rallied yesterday was because of the launch of Glumetza generic, which is basically a diabetes drug that lupin is present in. Now Sun Pharma had received approval all the way back in August of 2016. They couldn't launch the drug due to scaling up issues, and now the drug itself is diluted down to around a $20 to $25 million opportunity. But Sun Pharma rose on the hopes that this drug is now launched, because the launch pipeline for them had been slowing down. So I think that would be the key theme for Sun Pharma. Unless it is a complete disaster of a set of numbers or a complete positive surprise, it will be these kind of pieces of information, such as a drug launch and where it's coming from, which would probably move the stock for Sun Pharmaceuticals, because everybody knows what kind of pressure the US market is any which way facing for Sun Pharma. That means commentary would be more important than the numbers.
All right, Ekta, commentary for Sun Pharma more important than the numbers. Cadila, what's the expectation there?
Well, for Cadila, we are expecting a good quarter to come through. So the revenue growth should be around 26.5%, margins at 24% versus 18%, and a profit growth of 35%. Now, the reason for this is because of, you saw what happened with Natco Pharma. One of the reasons the stock rose was the stock performed, or the numbers performed well, was because of the Tamiflu generic, the flu drug in the US. Now, we all know that the US has had a terrible flu season, and because of that the sales of Tamiflu had risen in the past couple of months. So Cadila along with Natco are the sellers of this particular drug in the US, and hence they should benefit from it. Besides that, there is Lialda generic as well, where it is a limited competition drug, and it is estimated to probably contribute around $50 to $60 million for Cadila this time round. So that too should probably aid in terms of the numbers for the company this quarter. So that's the reason why you should probably see a good set of numbers for Cadila. Again, commentary is key, and what the US business is looking like.
Jet Airways. That's the stock on our radar after the company posted a very weak set of numbers this quarter. They posted a loss on the bottom line. Sonia was listening into the conference call of the company held last evening, and she's here with all the details. Sonia.
Well, thanks, Mangalam. I expect the stock to be under further pressure because the management in their own admission says that yields continue to be under pressure, especially the Gulf markets, which have been very weak for them. And that pressure could continue in the next few quarters as well. Also, increasing fuel prices has become, an issue for them because they are unable to pass on the prices to consumers, especially in the competitive routes. Not just that, their balance sheet continues to be very stretched. So yesterday, they did mention how their gross and net debt has increased. In fact, they continue to be free cash flow negative, and their net debt has gone up by 233 crores on a quarter-on-quarter basis, now stands at almost 8,200 odd crores. They also mentioned that airfares will continue to correct over the next few months, so that's something that they forecast as well. There is some turmoil within the top management too. There are some reports which indicate that the CEO could be on the helm of resignation. Of course, all of this will put further pressure on the company. Back to you.
Okay, all right, Sonia, thanks very much for that. So that's on Jet. But United Spirits reported what was a mixed set of earnings this quarter. Revenue was up 7%, but EBITDA margins declined due to an increase in employee expenses and advertising expenses. Sonal is here to tell us more. Sonal?
Actually, you've summed it up quite well, Ekta, but it was a mixed quarter, as you already said. Volume growth was quite strong, but margins is where it led to the disappointment. In terms of revenue, went up by 7%, mainly driven by the volume growth and also some price hikes that the company had taken. But margins, they contracted by around 30 basis points versus our poll of an expansion of 140 basis points. Profits were up 13%, but that was mainly driven by higher other income that increased by 500% and also included a one-time gain on sale of property. Margins were under pressure mainly because the employee expenses, they went up by 53% and ad expenses went up by 34%. Now if we come to the segments, prestige and above segment that contributes around 60% to their revenues, there we saw a volume growth of around 15%, which is quite strong. Popular segment, however, showed a decline of around 13% in the volume growth versus an estimated decline of 9%. But that was on the expected lines because this is the particular segment where they have taken a change in the operating model. Other highlights from the results were that the company had taken price hikes because of which the gross margins improved, and they also reduced debt by around 800 crores in this full year. Management again is very positive. They guide that they'll be able to achieve double-digit top-line growth and also will be able to maintain margins in high to mid-teens. Back to you.
All right, Sonal, thanks a lot for that. So after a flight, a peg, it's time to talk tech. Tech Mahindra will be in focus ahead of its fourth quarter numbers. Reema is here with the expectations. Reema.
Hi, Mangalam. Thanks so much for that. Yes, the last of the Tier 1 tech companies to report their numbers, Tech Mahindra. It is one of the best performing Tier 1 IT stocks this year with a rally of more than about 35%. And the key reason for that is the consistent margin improvement that we've seen for Tech Mahindra in the last few quarters, close to about 450 basis points in 3 quarters. Key number expectations, dollar revenue growth seen higher by 2.5%, and this will be driven by 80 to 100 basis points benefit on account of cross currency. Track the margins very closely. At the EBIT level, we're working with 13.5%. An improvement of 80 basis points, but compare it to the margins that they had a year ago. EBIT margins in March of 2017 were at 8.2%. So compared to that level, we've seen a significant improvement. This margin improvement has been aided by an improvement in utilization. Their subsidiaries, a couple of these acquisitions that they did have started turning around, like LCC, Comviva, Pininfarina. In fact, LCC had an was EBITDA positive in the prior quarter. Also, they've cut back on their headcount. So there is 11% reduction in their headcount compared to the earlier quarters. Profits are largely seen on the flatter side. What is the street going to watch very closely from the management commentary? A recovery in the telecom business. Secondly, does the enterprise business continue to grow above the industry growth rates? Does the margin trajectory continue from here on? We've seen a material reduction in the company's headcount. So what is the company's outlook on that? If demand is picking up, do they need to add on to their headcount? And their deal wins have been in that band of $250 to $350 million. Is there a material breakout from here on? The valuations are cheaper compared to what Tier 1 IT companies are currently enjoying. Back to you.
All right, let's talk commodities then. Manisha Gupta joins us with all the updates from the commodities corner. Morning, Manisha.
Hi, morning, and thank you so much for that. Well, some profit taking is what we have begun where you have seen prices trade below 79. This is on the back of U.S. inventory increase. Also statements that OPEC may look to boost production to fill in the gaps that are being created by countries like Venezuela and perhaps Iran. Also, there are statements with Russia that they are willing or looking to discuss phasing out supply curbs when there is an OPEC and the allies meet on 22nd of Jan. And the other thing also is that market is taking out profits as we see prices unable to sustain above $80 per barrel. So that tells you that there is perhaps some more, light hands that could get out of the market, pulling the prices further down from here. At least a couple of dollars down from here is not ruled out. It is a metal space that you have to keep an eye on because we have seen short covering come in for gold. We did see a low of $12.88 in this week itself, but we are trading above $1,300 ounce per back in case of the markets there. In the metal space, you really have to give it to lead because we have seen that as an outperformer for this week. It's trading at a 3-month highs. It's a 7% of a gain that you have seen in lead, and that is because of the shortage in inventories in most warehouses. That seems to be keeping those prices higher.
Okay, all right, Manisha. Thanks very much for that. But Mangalam, what are you tracking from the F&O space?
Well, a couple of things stand out, Ekta. Yesterday we moved about 80 points for the Nifty. The Nifty Bank too moved higher, but when we saw the data, the open interest on both the Nifty as well as the Nifty Bank declined by about 1% and 2% respectively, and that means that there was a lot of short covering. However, if you take a look at the selling, that has been continuing because the intraday indicator that we have, which is the futures premium, that turned into a discount yesterday, and that discount only widened. A large part of this also because we're closing in on the expiry. But keep an eye out on the FII selling. That one continues relentlessly in index futures. So yesterday too, we saw about 400 crore worth selling in the index futures by the FIIs. And what has happened is that the FII long exposure, which was around 54-55% at the start of the series, 56-57% at the peak of the series, has now come down to 45%. So there are more shorts than longs. So we'll keep an eye out on whether these guys get follow through or not, because if not, then there is case for short covering. What did stand out is the 10,500 put. The Nifty conquered the 10,500 mark, and we continue to see some writing out there. This has the maximum open interest, so this could be an important level to watch out for ahead of the expiry week that begins next week. Two stocks we have to watch out for: Jet Airways, Gen Irrigation. Both of them fell yesterday in yesterday's trading session. They've re-entered the F&O band. Let's see which way they move today.